Welcome to SICA session on GRAP 104, Financial Instruments, revised in 2019. This important update is effective from 1 April 2025, marking a key milestone in financial reporting standards. Let's explore what is new and what these updates mean for your organization. The objective of this session is to navigate the changes that have been made in the standard. A high-level overview of the following items will be covered in this course. The differences between GRAP 104 and GRAP 104 Revised 2019. How financial assets and financial liabilities are classified, how to deal with reclassification, and the initial and subsequent measurement of the financial instruments. Additionally, we will discuss the expected credit loss and the requirements around presentation and disclosure. For ease of reference, we have included the abbreviations that are covered in the slides. Let us take a look at them. Financial guarantee contracts issued by an entity were recognized and measured and/or disclosed in accordance with GRAP 19. Whereas in the revised version, financial guarantee contracts are included in the scope of GRAP 104 and are accounted as follows. Financial guarantee contracts are initially measured at fair value, and where a financial guarantee is issued in a non-exchange transaction and there is no reliable measure of fair value, the initial measurement is based on the loss allowance determined by applying the new impairment model. Subsequent measurement considers the higher of A, the loss allowance determined using the new impairment model, and B, the amount initially recognized, which is the fair value less, when appropriate, the cumulative revenue that has been recognized. Loan commitments issued by an entity were recognized and measured and/or disclosed in accordance with GRAP 19, which is similar treatment as financial guarantee contracts. However, for commitments to provide concessionary loans, the entity will measure the commitment at the higher of A, the loss allowance as determined using the new impairment model, plus any social benefit provided, and B, the amount initially recognized, which is the fair value less, when appropriate, the cumulative revenue that has been recognized. This amount is recognized in accordance with the framework for the presentation of financial statements. Under the GRAP 104, financial assets are classified as either being measured at amortized cost, fair value, or cost. The classification of financial assets is based on the definitions. Under the revised version, financial assets are classified as either being measured at amortized cost, fair value, or cost. The classification of financial assets is based on the entity's management model for managing the asset and the contractual cash flow characteristics of the asset. Reclassifications are not permitted unless the instrument was a combined instrument, required to be measured at fair value, or the fair value of an investment in a residual interest is no longer available, or vice versa. GRAP 104 Revised states that reclassifications are permitted when there is a change in the management model for holding the instrument. The following financial assets are measured at amortized cost. Non-derivative instrument with fixed or determinable payments that are not held for trading, not designated at fair value. A financial asset is measured at amortized cost if the objective is to hold financial assets to collect contractual cash flows. Contractual terms of the financial asset give rise on specified dates to cash flows that are solely payment of principal and interest on principal, SPPI. The following financial assets are measured at fair value: derivatives, combined instruments designated at fair value, instruments held for trading, non-derivative instruments with fixed or determinable payments designated at fair value, and all financial assets that do not meet the definition of financial instruments at amortized cost or cost. A financial asset is measured at fair value through surplus or deficit unless it is measured at amortized cost or cost. There was no change in financial assets at cost. In terms of the existing requirements in GRAP 104, interest revenue was calculated based on the gross carrying amount of the financial asset, using the effective interest rate of the asset. This was the case even when a financial asset was considered impaired. To overcome the potential overstatement of interest revenue and impairment losses, a distinction is made when determining interest revenue on assets that are impaired. The gross carrying amount of a financial asset is the amortized cost of a financial asset before adjusting any loss allowance. Under the existing GRAP 104, an entity would have assessed whether a specific event occurred that indicated that a financial asset is impaired. For example, a debtor entering bankruptcy. This is an incurred loss model as it focuses on losses that arise based on the occurrence of a specified event. The amount of the impairment loss in the existing GRAP 104 would have been calculated based on the difference between discounted cash flows that an entity expected to receive based on the event that occurred and the carrying amount at reporting date. Under the revised approach, an entity determines impairment losses based on the credit losses an entity expects over 12 months or the life of the instrument. This is an expected loss model as it focuses on both current and future expected losses. Unlike the existing principles in GRAP 104, an entity recognizes an impairment loss on day one. The approach comprises two steps. Determine the period over which an entity determines impairment losses, for example, 12 months or the lifetime of the instrument. The life of the instrument is used where there has been a significant increase in credit risk. Calculate the probability-weighted value of losses based on current and future data. The approach means that an entity needs information about the credit risk of the parties it transacts with and needs to develop models that assess both current and future losses on a probability-weighted basis. For receivables and lease receivables, an entity can use lifetime losses of the instrument and can use provision matrix to determine credit losses. An entity discloses by class of financial instrument the information required by the standard. The most significant change relates to disclosures related to credit risk. This will enable users of the financial statements to understand the effect of credit risk on the amount, timing, and uncertainty of future cash flows. There are a number of detailed disclosure requirements outlined in the amendments related to the impairment of financial assets. The disclosures are, however, a reflection of accounting policies and principles applied to recognize and measure impairment losses. As such, the information should be readily available. Judgment will need to be applied in deciding the level and extent of the information provided in financial statements. Many of these disclosures are unlikely to be relevant to entities with simple financial instruments.